So welcome to the webinar. Once again, tonight's topic is titled How to Value Stocks. What we're going to look at is 8 different valuation models that are probably the most widely used, because the biggest problem people have is not identifying stocks where the companies will grow their revenues and their earnings, but is timing those buys. And that's really what separates us as value investors from the majority of the herd, is that we have such a focus on price that we try to put an intrinsic value on a stock and then purchase shares only when it's trading at a price below that. So, okay, perfect. All right, so how to value stocks. Quick disclaimer, obviously everything we present here, to the best of our knowledge, true and accurate. As you know, all the data for GuruFocus.com comes direct from Morningstar, and then the team here at GuruFocus does all the calculations and codes everything to project in the way it is. But if there are errors or mistakes, please allow us to be human in that regard. So really quickly, with the valuation models, a lot of you have probably seen this, okay? It's the main page when you put in any stock symbol. This is the little window at the top of that page. Whether you're looking at the financials, insider trades, whatever it is, this is the heading. And okay, so this is the screen you see. Obviously, you put in the ticker symbol. This is what's at the top of the page. And I want to kind of explain to you tonight what each of these things mean. We're going to go in pretty good detail about them. But really quickly, you see there's bars and a dotted line. So if you guys haven't seen this, this dotted line right here represents where the price of the stock is today. And then each of these horizontal bars in this histogram represent where that valuation model price puts it. Okay, so Apple's trading here on 525. Tangible book is way back here, but then the Peter Lynch value is well in excess of that price. So basically, the more of these you see over to the right side over here of that bar, the better the chance is that stock is undervalued. And when you see them where you've got a dotted line way out here and none of the histogram bars are reaching it, odds are better in the favor that that stock is a bit overvalued based on these metrics. But let's go ahead and move forward. I want to go through each of these. Obviously, there's net current asset value, tangible book, projected free cash flow, median price to sales, Graham Lynch. So we're going to go through each of these one at a time. Now, really quickly, most of you already know this. I just want you to keep it in your mind that not all stocks are created equal, right? Every time we buy a stock, we're not always looking for the same thing. Well, we're always looking for the price to go up. But there are different strategies for investment, right? There's several different types, and just the 3 big ones that most of you guys are probably familiar with are right here. Nets and like asset plays. This is when you're essentially just trying to buy a bag with $10 in it for $5, right? A lot of you guys get into BlackBerry at $5, $6, $7, for a quick push out there. Stocks trading below book value. They often call these cigar butt investments. There's a couple of puffs left, but it's just when you think a stock's worth $10, you see it trading for $6, you buy it, you try to sell it out at 10 and flip it out, right? Second group is the more mature, stable companies, right? This is what most of us are probably used to. This is your IBMs and your Exxon Mobils and your Procter and Gambles and the quote-unquote boring stocks. But with these, you're looking for more steady, long-term returns, okay? And obviously, all that is dependent upon the price you pay. And Lynch did a lot of these. Buffett, this is really what he does today, largely because of the size of capital he's managing. Howard Marks big on these. Early Buffett was more the Ben Graham school, the nets and the deep discounts. And finally, there's growth stocks, right? And this is Peter Lynch. Obviously, did several different categories of investment, but he's really known for his growth stocks, and Icon's a big growth stock guy. And these are really the big return, higher risk plays. Okay, this is where, if you buy it at 30, you're okay if it goes to 20 or 15 because you're hoping that stock goes to 200. So you have a little bit higher risk tolerance, but you're looking for a multi-100% return. So just keep that in mind. It'll play into these valuation models as we go through. So the net and the asset plays, there's really 2 very basic valuation models are the best to use for these. Okay, if you're looking for stocks trading less than book or trading at discount, the first is net current asset value. You hear it referred to as NCAV, and you'll hear Ben Graham's name referred to this a lot. And he bought stocks at the greatest possible discount he could. He just looked for stuff that was just really, really marked down. This is the formula for that. So it's the cash and equivalents the company holds. Okay, so whatever they have on the books, plus the accounts receivable, 75% of the accounts receivable. So what that does is uses 0.75 to account for any slippage or loss. If some of the accounts don't pay, that money doesn't come. And then 50% of inventories, because once again, you don't know what the company's holding those inventories at. It's probably not worth that, right? If worse came to worse, the company had to shut down operations, they went bankrupt, the odds are they're not going to get full value for those inventories. So you put a 50% haircut on those as well, just for a bit of an additional margin of safety and get a true representation of what those are worth at fire sale prices. And you subtract everything they owe. Okay, so it's kind of, it doesn't look at earnings at all. It just looks at what they're holding on to. That's the net current asset value. And Benjamin Graham, kind of the godfather of value investing, Warren Buffett's mentor, this is what he specialized in with his firm, and he made tons and tons of money. I actually read an interview with him before where he retired. He just got bored because it was so easy back then to find these. But generally, if you can find a stock trading at a discount to its net current asset value, it's generally pretty tough to lose money in those unless it's a company that's just hemorrhaging cash. Okay, that's net current asset value. And next one, really easy, just tangible book, right? Very similar to net current asset value, but you leave some. It's just a total book value minus the intangibles. So it's tangible book value, anything that's real and you can feel. It takes out patents. Different licensures and things like that that aren't hard assets. So it's a little bit loose. Net current asset value is a really deep discount. So these are the easiest two ways if you're looking for those asset play type stocks. And these are the main things used to value those. It's very, very simple, but generally speaking, the closer you can get a stock to net current asset value, the greater the potential reward can be. Greg, yeah, this is on a per share basis. The net current asset value, you can either do the whole company and divide by the number of shares, or you can do the cash per share times 75% of the accounts receivable per share. But the figure we give you on the website just is a per share figure. All right, so those are the two easy ones. Now it's going to get a little complicated, or a little more complicated, but I want to go through the others as well with you. Okay. So the following ones can be really used for all stocks. These are specialized in kind of those deep discount asset plays, but let's look at what you can use for other stocks because the majority of your investments are not falling in this category. All right. Now, the first is a discount cash flow. Okay, I assume you guys understand how to use this. How many of you do not understand discount cash flow or have never used a discount cash flow calculator on the website? Elias, you haven't? Okay, some of you have, some of you haven't. Okay, well, discount cash flow, this is the calculator that Charlie's built into the website, and it's a really interesting feature, and I'll show it to you live in just a moment, but essentially what it does, and the discount cash flow model is probably the most widely used valuation model out there, is it tries to put a precise dollar figure on a stock based on the present value of all future cash flows of this company. So here's how it does that. It starts with the earnings per share, which is what this company earned last year. It predicates a growth rate of those earnings over the next 10 years. Now, this is by default going to be the 10-year EBITDA growth, but you can adjust it. This is really going to play a big role in the value. And then a terminal growth rate of what it's going to grow at for years 11 through 20. Okay, it's trying to forecast the cash flows for the next 20 years and discount them back. Once it has those figures, it's going to discount all of them back at a rate of 12% per year to give you a total value of what that is worth today. And that gives you this fair value figure here. So you see it's comprised of two components. One's the growth value. That's what it's going to do in years 1 through 10. Next is terminal value, what years 11 through 20 are worth. And then if you choose to, you can add any tangible book value to that fair value figure and get it even higher. There's kind of different schools on whether you should add it or not. Generally, I'll only add like net cash. Anything else, I figure it's just a cost of doing business, and it's something they're going to need to continue to generate those kind of cash flows. Now, I've got a few questions. How long is the webinar? 1 hour long. Earnings and cash flow are not the same thing. No, Norman, they are not the same. We use earnings per share. You can substitute free cash flow. Again, every one of these figures in these boxes you can manipulate yourself. Emmanuel, did you say, yeah, growth rate is the EBITDA growth rate, right? And the reason we use EBITDA, which is earnings before interest and taxes, the reason we use that instead of earnings is that one-time events can really fluctuate earnings further, whereas EBITDA, just kind of gross profit, is a much smoother line. I'll give you a better idea of the growth rate of that company. How do you determine the discount rate? John, the discount rate most people use, and when I say most people, I'm talking like, professionals that are professional value investors, use between 9 and 12%. We use 12 to make it as safe as possible. The lower the discount rate you use, the higher the fair value you're going to get. Anything in excess of 12, I think, is excessive, but somewhere between 9 and 12 is generally the way to do it. Kim, what do you find the earnings per share? It's on the 10-year financial. I'll show you that in just a moment. And yeah, Emmanuel, it's the standard 12%. Okay, so if you're not quite understanding discount cash flow, this is what it's trying to do. Okay, so this is what discount cash flow is putting behind that pretty little calculator. All right, it's saying, okay, this company's earning about $100 a share right now. We think they're going to grow at 10% for the next 10 years, then 4% for the following 10 years. And this is what, assuming these growth rates, that earnings per share will be for the next 20 years. Then it takes each one of these figures, discounts it back at a rate of 12% per year. So $110 a year from now is worth about $100.92 to you today. $121 2 years from now is worth this. So it goes on and on and on, and it totals all these up, gives you this figure, and divides by the number of shares, and that's your discount cash flow figure. So, Warren Buffett was quoted in a shareholder letter in 1992. The clearest definition he's ever given on the valuation of a company is that the intrinsic value of a stock is the present value of all the future cash inflows and outflows at present values. Okay, so that's what he's looking at. How much cash can I take out of this company over the next 20 years, and what is that worth to me today? And yes, boys, as you said, this one uses this one I think is using a 9% discount rate. This is just a different example. I just want to show you what it looks like. But you can use anywhere from 9 to 12. 12 is extremely conservative, so the value gets going to be lower, but you're going to have a lower chance of overpaying. 9% is, I use 9. Charlie likes 12. It's really, the thing is, it's not going to be a case where you do the math and you think, oh, the stock's worth $104.02, trading at 104.03, I'm not going to buy it. I mean, it's very difficult to put a per penny value on any stock, but you want to get a pretty close estimate based on conservative estimates of growth and a conservative discount rate of what you believe that stock is worth to you today. And if it trades at a discount to that, generally it's a good buy. If it trades at a level in excess of that, it's usually slightly overvalued or excessively overvalued, depending. Exactly, John. Yes, higher discount rate. And I'll show it to you live. It'll make more sense. Are taxes removed? They're not. No, this is, again, I shouldn't have used this example. I just put this up there to kind of give you guys a visual. So we'll look at it. We'll look at it live. Let's go ahead and look at it now. What the heck? Let's look at it live. Let me bring up a web page. Here we go. All right, so here's what it looks like, and I'll just use a random stock. We'll put in Microsoft. Okay, and you see down here is the DCF calculator, the discount cash flow calculator. And this is that image we looked at, and what it's going to do is, and I forget my internet's a little bit slow now because I'm broadcasting, but it's going to instantly put in all those figures. So it puts in last year's earnings per share. It puts in a growth rate based on what it's grown in the last 10 years, the discount rate, calculates any tangible book value if you decide to add it, and gives you a fair value per share. So the big variables here are, the biggest one really is the growth rate. Okay, so look at that figure, $46.50. If I decide, no, they're not growing at 13, they're only going to grow at 5%, look at the difference it makes to the fair value of that stock. So like with any formula, it's kind of garbage in, garbage out, right? I mean, you can make fancy graphs and charts, but if it doesn't do what you're thinking it's going to, you could drastically overpay. I mean, if you think Microsoft's going to grow at 20% a year, and you buy with an assumption of a $73 value, your value is going to be wrong if they only grow at 4 or 5% the next several years. So we've put all this data right there in front of you to give you an idea. Here's all the growth rates. So you're seeing how fast they're growing revenue, EBITDA, earnings, free cash flow for the last 10 years and the last 5 years. And so I generally suggest you just kind of make a conservative estimate based on these figures if you're not intimately familiar with the company. Okay, so I'm seeing, they're growing faster over the 10 years than they are over the 5, so they're probably slowing down a bit. I know how huge Microsoft has gotten. I know they can't maintain the growth rates they had in 02 and 03 and in the 90s. So what am I seeing here? I'm seeing, anywhere from about 6.5 to 9.5%. And when it comes to the revenues and the earnings. So let's just say I want to be a conservative guy. I'm going to say I think they're going to grow at about 7% a year. I'll use my discount rate, and I get a fair value of around $31. Now, you may think they're going to grow in faster than that. You may think their earnings should be higher. You can switch back to the financials, and you'll quickly see their earnings per share and their free cash flow per share, both right here. Okay, so if you want to use free cash flow instead, you can do that. Say, it's depleted a bit, but I think that they really should start at 290 or 3. And change those figures to what you're reflecting. So I don't want to tell you here's the exact way to do it. It'll give you to the penny. I mean, this is how you do this, but like anything else, it's all about the quality of the data you put in. So you want to be reasonable with your estimates. I mean, if you think it was a low year, you want to use free cash flow instead. Maybe it was 280 or something like that. Maybe you think they're going to grow at 8% instead of my 7. You only want to use a 9% discount rate. You're not quite as conservative. You get a higher value. So anyway, this is how this is going to work, and I encourage you to just kind of play with this to kind of get a feel for how this calculates values. A couple of things quick. I mean, the biggest thing, one, is going to show you all the growth rates down here, so use that information to try to make an educated, conservative guess. It automatically gives you a margin of safety, so it's showing you what percentage of safety, what percentage today's price is below your fair value estimate. And then finally, there is something called the reverse discount cash flow. Okay, and this is kind of neat if you're just trying to figure out if a stock's a decent buy or not. Because what it does, now you notice a few things disappeared when I clicked that. The growth rates all disappeared. So what this is doing is saying, okay, based on today's price, this is the rate Microsoft's going to have to grow their earnings at for the next 10 years to justify this price. You think they're going to grow faster than that, it's probably a good buy. Slower than that, it's probably a poor buy. Horn, it's a good question. He asked if there's an earnings per share without one-time events. I believe Charlie's actually working on that, if I'm not mistaken. I'm not sure if that's being released, but yes, we are looking at doing earnings per share without one-time events. But it is not released yet. And Noah, how to use it with the free cash flow? I mean, you just swap this figure right here. So you just put free cash flow per share instead of earnings per share. It's absolutely nothing different. Jeff, how about using the dividend growth rate? Jeff, dividend growth rate I wouldn't really use for the growth rate of the company because they can adjust their payout ratio. So maybe 1 year dividends make up 20% of the earnings. The next year it makes up 40% of the earnings. That's going to give you a false growth rate. Just because they're growing their dividend doesn't mean they're growing their earnings. You really want to look at bottom line. What are they growing their revenues or their earnings or their gross profit at? John, that's for the next. That's correct. Yeah, forever. And Borgia, the margin of safety again. It's just showing you where today's price lies in relation to that fair value. So you've got roughly 14% margin of safety, okay? All right, so that's discount cash flow. And let's look at a couple of others. Now, related to free cash flow, this is something Charlie created called projected free cash flow. And what it does is give you a dollar figure, and it's one of those histogram bars at the top of the price. So this is how it's put together. The value it puts out is the growth multiple based on the average the company's been growing times that free cash flow figure, plus it's adding in 80% of the total equity. Okay, so total equity is just book value, right? What do you own minus what do you owe? Well, some companies have a lot of cash on the books. For that, you want to give them full credit. Some have, a bunch of, maybe it's a computer company with a ton of inventory. We know computers are out of date in a week, and certain components are going to be phased out within 12, 18-month periods, so you don't want to give them full value. So kind of somewhere in the middle gives about 80% of that total equity figure and puts that together. So again, the growth multiple is automatically computed for you, combination of that EBITDA, revenue, and earnings per share growth. The free cash flow figure it gives you is a 6-year average. All right, so if you're looking at a very fast growth company, the projected free cash flow is probably going to give you a figure lower than what it's really worth. Because if they made, $1 a share in '08, and they made 2, and then 5, and then 10, and then 20, if it averages those out, you may get a figure of like $8 in free cash flow. But last year they did 20. Okay, so this is going to work a lot better for more stable companies. And then again, 80% accounts that overstated book value there. So you can click the bar, and I'll show you how that works. Within that, goodness, sorry, I've got a couple of screens here, but it's all getting cluttered on me. So this is that projected free cash flow. So up here at the top of the screen, remember I told you we're going to go through each of these. This is that projected free cash flow. So what are we seeing? We're seeing that in Microsoft's case, it's a little bit past the current price. So projected free cash flow is probably going to be, what, 40, 42, something like that. When we hover over it, we see it's $40.41. And if you click on that, this is a new feature, it's going to take you to this page and break it down for you. All right, so it's going to show you a couple of historical ratios. You're going to be able to look at a chart of what this free cash flow per share figure has been for the last 20 years. Some bubble comparison of the competitors. Where it is presently compared to historical ranges, where it is compared to the rest of the industry. We see its price to intrinsic value is ranked higher than 88% of companies in their industry. Okay, so ranked higher means they're just better, whether it's a low number or a high number. And then below that, it's got a full definition of this projected free cash flow. So you can kind of take your time, read through this, understand how it's calculated, so that you're really comfortable with the data and you kind of trust the figures you're seeing, or you agree with it or you don't agree. All right, but it's a really neat feature they added here, because you can click on each one of these and it will bring you to a breakdown of that figure, how it was calculated, and a definition of that, as well as how it stacks up to the industry. So I thought that was really neat, and I think it's a really cool feature. John, why is it 80% of equity? It's in the write-up there. I'd have to ask Charlie. I believe 80% is just like a ballpark number they use based on average tangible book to total book value or something like that. John, you want to see an example? Okay. Let's go to an example. So here's projected free cash flow. So let's go back to Microsoft. And here is projected free cash flow of Microsoft. Let's see if we've got a breakdown per share of this thing. I don't think it's in here. It might take a little longer to do a breakdown of this one. All the other ones I'll show you an example of. This one there's just so much calculation in. I don't want to take up 10 minutes of the webinar, but you can definitely read through it there. It'll break the whole thing down for you. All right, so that's projected. That's probably the more complex one. Again, a lot of it is already done for you. I'd encourage you to read that if it's something you're interested in. But you can see that in all the financials. In the 10-year financials down the premium feature, the premium section where it gives the valuation models, it'll show you the projected free cash flow figure, and it's just another cool valuation model. So here's a simpler one for you guys. Okay, And this is, again, kind of more for your blue chip, more mature, more stable companies, okay, that have been around for a while. We're talking Dow Chemicals and IBMs and Procter and Gamble's and Kraft Foods, if they still existed, and these types of companies. So all it does is look at the total annual sales, or total money in the door, divided by the shares outstanding times the 10-year, should be median price to sales. So what does that mean? It's very simple, okay? This company traded at a price to sales ratio of anywhere from 2 to 6 for the last decade. Maybe the average was, we'll call it 4. This year they did $10 in sales per share. If they generally trade at 4 times sales, and sales are $10 a share, that's going to put the price at about $40, right? So this works best for, again, your stable, more retail type stocks. This even goes to your J.C. Penney type companies, your American Eagles. Companies that are generally, the retail sector is more heavily looked at in this regard. It depends on historical valuation levels. So again, if you've got a fast growth company, an up and comer that maybe trades with the rest of industry is trading at 5 times sales, was trading at 25 because they're growing so fast, it's not going to be quite as accurate. So you want to reserve this for these seasoned companies that have been around for a while. And it also does not factor in growth. So just another point to avoid the growth stocks on this. But as with the other, you can click that bar in evaluation box, and it's going to give you some more details, and I'll show that to you really quickly. I've got about 20 things running here, just bogging my computer down. But again, right up here, median per share value, if you can see that, it's the orange bar from across the top of the valuation tab. And we're seeing Microsoft trade at a discount to its average per share value. And we click on that. Once again, it takes us to another page, breaks it down for us, gives us that median per share value, tells us how it stacks up to historically. So it says as of today, blah, 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 the 10-year price to median per sales range has been between 0.62 and 6.5. So we're definitely on the low end of that range at 0.9 today. It's also ranked higher than 89% of the 1,500 companies in their group. So a quick note on this one, it says it's ranked higher. Some metrics we want to be low, like price to earnings or price to sales. Others we want to be high. It's going to say higher if it says ranked higher. Okay, so just know that higher is always better in compared to when being compared to the industry. All right, and once again, it gives a full definition, how this is broken down, how it's computed, and explains this with you there and shows the historical data. Should talk. We'll do this for staples. Yeah, what's staples? SLPS, SPLS. What is it? Yeah, SPLS. So we look at staples, for instance. I'm sure they're going to be in the low end of their range, and you see that being exceeded based on their median per sales value. This company has traded historically at a range between 0.5 and 2.4, and they're now at the absolute low end of that at 0.46. Now, obviously, with staples, we know there's more to this, right? We know the brick and mortar industry and the office supply business has been hit, just like Best Buy has been hit, and they're trying to survive against the Amazons. And the online competitors. So obviously there's a reason it's on the low end, but just one more way to value the stock and look at it from that angle. So that's the median price to sales value. Okay, does that one make sense? It's pretty easy, right? And you can understand the kind of stocks you'd use it on. Stocks that are very dependent on sales. What same store sales do? What are they selling per square foot? Right? I mean, it's fairly straightforward. Are you going to use this for Google? No. Are you going to use this for Tesla? No. But can you use it for J.C. Penney or J.C. Penney is a bad example. They're in the dump right now. But an American Eagle or a Foot Locker or something to that effect. Absolutely. Okay. Now, who's heard of Mr. Ben Graham? Walmart's another example. Thank you, Greg. Mr. Ben Graham, this is the Graham number. Now, in the book The Intelligent Investor, aka the Bible for all you value investors out there, he didn't lay out the specific formula, but he laid out all the information that's created. And a lot of people are using it. So here's what he said in that book. Now, obviously, the Google caliber companies weren't really around at that time. So he's looking at more stable enterprises. But he said, one, you should not pay more than 15 times the 3-year average earnings per share. Okay, so in other words, PE less than 15, right? You want to pay less than the 3-year average there. He also said you don't want to pay more than 1.5 times book value. Okay, but he said if you get it for maybe 10 times earnings, you can pay a little bit higher book value multiple. Or if you get it for maybe 1-time book, you can pay a little bit higher earnings multiple. So what he said is that the product of these two, the product of your earnings multiple and your book multiple, should not exceed 22.5. Okay, so the PE number times the price to book should not be over 22.5. So what this does is quite simple. It just multiplies the book per share and the earnings per share by 22.5, and then takes the square root of that. And that gives you the max figure that Graham would pay for that stock, based on keeping a combination of below 15 times earnings and 1.5 times book. So where does this one fall short? Well, obviously it's going to underestimate growth stocks, right? I mean, Google's a fantastic company. Are you going to get the chance to buy Google at 1.5 times book or 15 times earnings? If you do, it's going to be a fantastic opportunity. For the most part, you don't get to. So it's going to underestimate growth stocks, as we know we're willing to pay higher multiples for faster growth. And it's going to punish companies that are really light on book. All right, so and Google keeps coming to mind, but they're a company whose the majority of their products are not physical products, right? They don't have to put something in a box and mail it every time they make a sale. Most of it is a digital product. So their book value is going to be relatively light compared to most other stocks out there that are shipping physical merchandise. So, they may trade at an incredibly high price to book value. Doesn't necessarily be a bad thing. So here's the downsides of this. But once again, if you're looking at your more stable companies, your more traditional stocks that have been around 20, 30, 50 years, the Graham number is a nice way to be sure you're paying a very reasonable price, and one that Graham thought was reasonable in the 1920s, which would definitely be reasonable at today's absurd market levels. So, as with the others, you can click the bar. It's going to give you a breakdown of the Graham number. We don't have to look at that right now, but it works exact same as the others. I mean, Charlie's done a wonderful job with this website, making everything clickable, making everything pop up with definitions and explanations, and it's created a really great user experience, because no one gets a membership to GuruFocus already knowing all this stuff. And one of the beautiful things about it is how much it teaches you and shows you, and kind of makes you more of an expert. So definitely, if you see anything you don't understand, click it. Just click away. I promise somewhere on the website is an explanation, and I'll show you how to find more of them in a minute. Now, 2 more I want to show you. Okay, you guys getting bored of this yet? No, you're good, Greg? Okay, so 2 more. This one's fairly simple. This is the Peter Lynch fair value. Again, this is one that Charlie came up with here, but it's based on Lynch's books, One Up on Wall Street. The other one slipped my mind right now, but what it takes is it's very simple. The 5-year EBITDA growth rate times the earnings per share. Okay, because Lynch is famous for saying you want to pay an earnings multiple less than or equal to the growth rate. Okay, so if a company is growing at 20% a year, he'd pay up to 20 times earnings for it, or PE of 20. If it's only growing at 10% a year, he doesn't want to pay more than 10 times earnings. All right, so again, we're using EBITDA. I've done a lot of research on this, but EBITDA just really depicts a cleaner rate. I mean, if you think about a company that has maybe 3% margin, so they did $1 million in sales, and at the end of the year their profit was $30,000. Okay, well, if they had a one-time expense of like $10,000, which is not much, their earnings per share, their net income, took a 33% hit. But their EBITDA, which is a much greater figure, probably shrank, within 4 or 5%. So it just gives you a better, cleaner picture of what that company is growing at. And so again, PE less than growth rate. Another way to look at this is a PEG ratio of less than 1. That's all the PEG is. It's just a PE over the growth rate. And on GuruFocus, that uses EBITDA growth. Okay, so the peg's less than 1, it's meeting its criteria. If it's greater than 1, it's not meeting its criteria. So this really gives you a rough estimate for growth stocks. Now, should you look at this and say, "Yep, it's a buy," and move on? No, I mean, do your due diligence. Make sure they're not buried in debt and issuing a million more shares every quarter, and have a product that's blowing up in people's hands or anything. But it'll give you a quick look. If you're looking at a growth stock, boom, top of the screen, that valuation box we looked at. What does the Peter Lynch value say? Okay, I know I'm looking at a growth stock. How does it stack up? Am I trading a multiple? Is it trading at a multiple greater than how fast they're growing? So once again, bar's clickable, gives you more details. And John's asking, how do you tell if the company's issuing more shares, and does it matter or it affect things? It absolutely matters. Let me go. Well, I'll go ahead and show you now, John. What the heck? I hate to get off topic, guys, but I want to show this because it's incredibly important for anyone investing. So let's look at Microsoft. We're just going to stay consistent with one company. If you go to the 10-year financials, John, what you're going to want to go to is the income statement. All right, so we're going to scroll right down here to the income statement. And on the last line of this income statement, sorry, I skipped past it. On the very last line, you're going to see a number that says shares outstanding diluted. So it's the number of shares the company has. Now, when we look at Microsoft, we see 10 years ago they had 10.8 million shares, then 10.5, then 9.8, and they've been slowly buying them back. The number is shrinking. Okay, so what does this do for you, John? Well, when a company's buying back shares, you got to think about it in a very simplistic point of view. Okay, let's say I own a company and I issued 10 shares. All right, and I charged you $10 per share. So my whole company is only worth $100. Well, so what do you own? If you own 1 share out of 10, you own what? 10% of the company. Is that correct? I know it's third grade math, but it's going to illustrate the point. So if next year I come in and do a buyback, and I buy back 5 of these 10 shares. Okay, so this number goes from 10 down to 5. Now there's only 5 shares. But you still own that 1. So what percentage of my company is your 1 share now worth, John? Because instead of being 1 of 10, you're now 1 of 5. So your 1 share is now worth 20% of that company. All right, so when they buy back shares, they retire them. So what it does is it shrinks the number of shares that are out there on the market. It makes the shares that you own worth a greater percentage of that company. And in turn, that's going to increase the earnings per share. Okay, if they make this fictitious company I was giving you with 10 shares, if I made $100, if this company, well, let's just say they made $50 a year. Okay, and there's 10 shares out there. What's the earnings per share? $5, right? And I'm sorry this looks so crude. I'm doing it with a mouse. $5 earnings per share. Well, the next year I buy a couple of back, and now there's only 8 shares out there. So now I got 50 divided by 8. So now, with only 8 shares, it's earning about what, $6.20, something like that, earnings per share. Even though they're still only making $50. But because there's fewer shares outstanding, mine represents a larger percentage of the company, and now earnings per share has grown up. Okay? So I hope this helps. And John, I know you asked the question, but for every time someone asks a question, there's 20 more people that would have asked it. So I know it's a very crude elementary example, but it's really important to understand this stuff because the opposite is also true. If you say the share count going up and up and up, what's happening to your stock? It's worth less and less and less as a percentage of that company. You're going to see this a lot with new up-and-comers. Like, let's look at Stratasys. Okay, it was a 3D printing company. A new firm that comes to market that just IPO'd, that's still raising money, that may not be profitable yet. What are they going to do each time they need more money? They're going to issue more shares, right? Because it's free money. They just say, all right, here's another million shares. Come eat it up, Wall Street. So see, they went from having 21 million shares, they pretty steady, and then what did they do last year? They almost doubled their share count. Now it's up here to 49 million. So whatever you owned at this company in 2004, it's like great. The stock is definitely, the company's grown, But they cut what I own in half by doing this. So instead of experiencing whatever this is, maybe what, 700% growth, instead you experience 350% growth because they diluted you. And that's why you'll hear people call stocks carnivores. They call that, you see the share count shrinking because they take their profits and instead of issuing it back to shareholders in dividends or reinvesting it, they buy back shares. And when a company buys back shares, it's the exact same thing as them giving you money because they're just making your stock worth more. But it's not kicked out as a dividend, so you're not paying taxes on it. All right, and that's why Carl Icahn wants Apple to take the billions they have overseas and do share buybacks, because now here's this company that was making $40 a share. Now all of a sudden it's making $60 a share and nothing's changed. So that's buyback. So keep an eye on that, okay? So sorry I got off topic for you guys that already knew that, but I wanted to be sure we covered that. All right, final valuation model. All right. And John, if it doesn't show undiluted, so diluted means like the share count including any options they issued for employee benefits and things like that. So you always want to look at the diluted figure. Undiluted is usually not much different though, no. Who's heard of Donald Yackman? He runs a fund out of, what's he in, Austin? Out of Austin, Texas. Great value investor, huge fund, billions and billions of dollars. He put something together he calls the forward rate of return. So what he tries to do is predict, based on today's price, today's cash flow, what this company's been growing, what rate of return am I going to get from this stock? Okay, so instead of trying to put, this stock's worth $20 or $30, you're going to say, okay, this one should return me 8% a year, this one should return me 15% a year. So here's how he does it. It's fairly simple. Again, like anything, it's easier with more stable companies. Okay, this is why growth stocks go from $30 to $300 back down to $10. They're really tougher to value because there's so many assumptions put into them. But when you look at, 3M and I don't know, in these large, stable, blue chip type companies, we have a pretty good idea what they're going to do. So they're easier to value. But here's what it is. So the normalized free cash flow. Okay, and what that is, he takes the last 7 years and averages that out. Now he also, in his formula, accounts for inflation in his. Okay, so it's already in there in the formula you're going to see. Divided by today's share price. All right, so that's going to give you what is it normally yielding, right? If this stock, on average, produces maybe $10 a share in free cash flow, and they're currently trading for $100, what's the free cash flow yield? Around 10%, right? Around 10%. Yes, it's the average of the past 7 years, normalized out. And then he adds the growth rate. So if he takes a look at what this company's growing, maybe they're growing, 5% a year, you've got that 10% yield, plus you've got some growth coming. So he's estimating his forward rate of return on this stock would be about 15%. Okay, a very, very basic example. And the growth rate they're using there is the lesser of per share or total revenue growth. Just what is he's just looking at gross revenue. Okay, he doesn't want to dilute anything down. What are they growing at? And I just showed you the effects of stock buybacks and stock dilution. So he's looking at it on a per share basis and also just the big total revenue figure. So he's using the lower one to be as conservative as possible. But it's, yes, the historical revenue growth rate. I think, what's he looking at? 5 years, Charlie? Do you know? 5 years? I think that's right. Don't quote me on that, but 7 years. Okay, so he must be, yeah, 7 years. And the reason he used 7 years, right, as Charlie pointed out, that's generally the time for a full market cycle. So FYI, full market cycle started in 09, 10, 11, 12, 13, got a couple more years left maybe. But yeah, that's what he looks at. So again, another example here, if you had a company generating on average about $5 a share in free cash flow, and it was at $100 a share, 5 over 100 is what, around 5%. Then you just add in what this company's historically been growing at, which is another 4.5%. And you get this 9.5% forward rate of return. So it's a nice way to look at stocks. Once again, the more stable, more mature, companies where you're probably putting the most of your retirement in longer term safe dollars, right? But it's a nice, easy way to say, well, yeah, this one looks like it's going to give me 15%. This one looks like it's going to give me 12%. Pretty easy decision for me, right? And this one is listed. It's not at the top where I showed you all the other ones, but it is listed down in the 10-year financials. We'll look at that in just a second. To the bottom of the 10-year financial page. So if you're overwhelmed with this information, I start with the All-in-One Screener, and it's a premium feature. So if you're not a premium member, I think you can do a 7-day trial. You got to put a credit card in, but like you can cancel anytime in 7 days. You don't get billed. So if you want to just try it, you can to kind of check it out, see if it's something you're into. And I'll show you how this works to kind of give you a better idea. There are also definitions and tutorials of almost everything. And I say almost. I haven't found anything that's not defined yet, but I'm sure there's something in there. And I'll show you how to get to this. If we... Now, I showed you how to click on each of these to get a breakdown of it. There's also, I don't know if you can see it on your screen because I'm projecting so much, this little tiny, which looks like a little text bubble with a question mark in it right there. If you click on that, it's going to take you to this full page Charlie did a write-up showing you each of the features here in the valuation box from when he added this in June of 2012. It's been around about 18 months, maybe 24 months. And, gives you a quick rundown on what the formula is. Is it asset-based? Is it growth-based? It kind of gives you some further explanations in there. So, kind of neat to find it there. The other cool thing, if you run into anything on this website you don't understand, if you take nothing else from today, take this. Here's what you do. Hover over home, okay? See where it says tutorials? Click that. Now, this is intimidating. I'm not telling you to go through each one of these, but all you've got to do, so say you're concerned about like the discount cash flow calculator, click the search box, D, C, F, sorry, getting a delay. Oh, then there we go. Whoops, got an extra F. But you can type anything you want to search for. Here's reverse discount cash flow, intrinsic value, discount cash flow projected. And just click on any of these topics. And Charlie's really, he's got like full write-ups with images and breakdowns of pretty much anything in here. So if nothing else, you could sit in front of this website for months and essentially teach yourself everything you need to know to be a fantastic investor. And I don't think I'm exaggerating by that. There's a little bit of inherent ability you're going to need as far as, knowing that BlackBerry may not be the go-to phone anymore. Some basic observations of the universe. But other than that, there's tons and tons of information here within this site. Craig, anyway, extend that. So yeah, Craig, there's actually, and I don't know why I did this, but there's a 7-day free trial. He's also got a 30-day full money-back guarantee. So try for 7 days. If you think it might be something you're into, just stay on it. Anytime in the first 30 days, you can call us and get a refund. After that, I think you'll even prorate the subscriptions. You really have no risk. I promise. He doesn't want bad blood. We're not trying to bait and switch. It's why we're doing these webinars to try to show you everything within the website. We don't want your money if you're not getting the value from it. So, again, it's a no questions asked refund. I promise you I listen to Holly answer calls all day long. So you want to cancel? Okay, done. And that's it. So don't feel like you're going to get trapped into anything. Margaret, when does the financial information on the website get updated? Is it when the 10Q or 10K is issued or during the 8K earnings release? Okay, when it's released, when the earnings are released, Margaret, we have preliminary figures that go in automatically, and then when the actual 10K and 10Qs are filed, it's, I think, within 20 minutes for the most part. All of them are into the website there. Emmanuel, I will definitely tell Charlie to get to work and stop slouching. Do you have plans for an Android app? Cheyenne, yes, we do. Charlie actually just had that. He's got a basic app. I think it only does the articles built for the iPhone. He's working on an Android one as well. He has plans for an Android one. John, yeah, the screener has pretty much everything publicly traded for the most part. If they're one that's not filing or anything like that, like if they're behind on their filings, it may not be listed. But yeah, pretty much everything. John, what's the difference between 10K and 10Q? One's a quarterly filing and one's an annual filing, John. So, Chris, what is Charlie's background? Charlie is a PhD physicist, believe it or not, who got interested in investing and then used the fact that he was a freaking genius to teach himself how to code and build this website for us. So it's kind of interesting. John, I like your example. So John asked, can we pick a company, say Disney or GE, and run through the valuation models and talk about how to integrate them? Okay, John, great idea. Good way to finish this up. So let's do that, then I'll turn it over to Charlie if you guys have any in-depth questions. I'll let him blow your mind on that side. So let's do that. Chris, it was your idea. I'm sorry, John, your idea. John Smith. Pick a company and we'll run through it. Joe, Facebook. So every valuation model is going to say Facebook's overdone. John says Disney. All right, let's look at Disney, and we'll run through our valuation models, and hopefully this will kind of give you a little bit of a better understanding of how these are working. All right, so it's looking like it's going to be overvalued by a lot of the metrics here, but let's take a look. Net current asset value showing a negative $16.32. So it's not a red flag. It's a great company, but they're just light on cash, right? So if we look at their 10-year financials, you see their income statement. They're holding, their balance sheet, $4 billion in cash and equivalents. You take a haircut to accounts receivables. It doesn't calculate, this $40 billion they have in buildings. It doesn't account for the $15 billion they have in machinery. Intangible assets, which in Disney's case are actually probably warranted for the most part. I don't know about $35 billion, but maybe if WhatsApp's worth $18 billion. And then it takes away total liabilities, which in their case is about $38 billion. So, again, Disney's not a net stock, right? We're not trying to get this at a discounted net asset values. That's not surprising. Same thing with tangible book. We're seeing about $5.7. Let's look at the projected free cash flow figure. In Disney's case, it's giving us $49.83. And interestingly, we're seeing this on the high side of its 10-year average. So when we look at the price to intrinsic value, it's at 161. The highest it's been in the last 10 years is 165. So definitely high on the historical level. Based on the industry, it's ranked a little bit. It's a little bit above average, 63%. It's above 63% of the companies out there. Not showing a huge discount, projected free cash flow wise, right? Let's look at the median price to sales. It's kind of a tough one for a store like Disney, but again, we're seeing this definitely kind of on the richer side of where it's been historically. So Disney's traded, it's had a price to median price over sales, a lot to take in, between 0.3 and 1.9 or 1.7. It's also right there on the middle of the industry, so just not a great deal, I don't think, based on these valuation metrics. The Graham number we know is going to be really low. Let's look at the Peter Lynch value. We're seeing this come in at about $50, and so earnings per share without non-recurring items were $3.64, and they're getting a value of 49.5. So it must be figuring around 15% forward growth. So take a look and see what that figure is. On the other hand, it generally trades well in excess of the Peter Lynch value. So we're actually on a low end for Peter Lynch value here. But if we take a look, see, so they're 49. It's figured about $50 a share, and it's earning $3.64. So let's see what growth rate they're using. I'm guessing EBITDA, about 13%. The last 5-year average, 13.8. So that really makes sense. I mean, Disney, it's a big blue chip. It's a great company, but we know it's definitely on the rich side. If we look at what the stock has done for the last 5 years, earnings have improved. They haven't improved this much. We're seeing a stock that's gone from, if I can get a price here, around $19 back in 2009 to $80 today. So, it's increased 300% over the last 5 years, which is really, it's about double what the market's done. So I'm not surprised it's a little bit overcooked. Yeah, exactly, John. High price, great company. Yeah, so Noel, thank you for that. The other valuation metrics, they are listed here on the 10-year financials page. As we scroll down, I'll show you where these are each located. This is just basic ratios, and all your per share data is at the top. I like that there. So if you're looking, what's the earnings per share, free cash flow per share, all that's at the top. But down toward the bottom, there's valuation. And here they are, valuation ratios and valuation quality. And we're seeing these listed here. And you can see where it's been the last 10 years. So here is the gram number per share. We see it's climbed, but we've traded in excess of it. Here's that median price to sales value per share and where that's been. Here's that Peter Lynch value. Here's that projected free cash flow value, net current asset. It even shows you the net cash per share. So this is just like the total cash minus everything they owe. So if you ever find a company with net cash, it is at that time impossible to go bankrupt. Okay, if you've got more cash than you do debt, there's really no way you can go bankrupt. It's showing you the market cap, enterprise value, some of these others as well. It also shows you here's the that forward rate of return we looked at from Donald Yachman. That's right here. So it's giving you where this has historically been. And then also the Joel Greenblatt earnings yield. One I didn't go over, but it's kind of similar to that. So what I like to do with these, especially anything that's a yield or rate of return, click here and just get a look at where it has been on average. Now Disney's kind of all over the map, but you'll see some where they come in. Generally it's got a projected about 8 or 9%. Now it's on the high side of that. You can put out the price to sales ratio as well, kind of get an idea, And here's a perfect example of why Disney's kind of looking overpriced. We looked at that price to sales number. Well, we see that for most of its life, it's traded between 1 and 2 times sales, right? I mean, there's a big dip in the '99 bubble and collapse there, but for the most part, it's been here, right, between really about 1.5 and 2, and now we're up here at 3 times sales. So as a value investor, it's a little bit rich, a little bit on the high side of where it's historically been. So I'm not going to say you're going to lose money buying it here, but over the last 10 years, it's definitely not the best time to buy a stock like this. John, net and net cash. I mean, net just uses, it's essentially the same thing. Net includes, net includes 50% of inventories and 75% of accounts receivable. Joe, what is PBR? I know it is one thing. I'm guessing that's not what it is. Petróleo Brasileiro. Okay, Brazilian Petroleum Company. Okay, so here's one that's not showing to be wildly overvalued, right? They got tangible book value in excess of the current share price. Projected free cash flows in excess. Median price to sales figure puts it at 17.5. Even the grand numbers at 27.6. So valuation-wise, it's coming in cheap. And this is really what you want to see, as many of these to the right of that as you can. Now, on quick downsides, obviously, it's only a 1-star predictability, so it's not a company that's very consistent with its earnings. I'm guessing if we take a look at the 10-year financials, we're going to see that reflected. Okay, so let's just scroll down the income statement. I mean, really quickly. It's not going to take but a second. Revenues have been, for the most part, pretty consistent until sometime last year. But when we take a look at net income, we're seeing kind of some fluctuations, right? We want to see it grow as smoothly as we can, just because it's easier to predict in value along these lines. We're seeing a little bit of choppiness here. So, would it be a surprise if all of a sudden, it went here one year? No. Would it be a surprise that happened to Disney? Yes, just because it's generally a more predictable, kind of looked at as a higher quality company. Dan says it's a very inefficiently run government-controlled oil company. So, yeah, that's one I'm not even going to step into. That's a scary one. But I hope a lot of this helped. I want to turn it over to Charlie really quickly because we're kind of approaching the last hour here, and I want you guys to have some time with him to ask any questions you've got. But again, Charlie Tian, he is the founder of GuruFocus.com, kind of the godfather, if you will, of the website. And you guys can ask him anything you want about features or make suggestions for anything that you'd like to see on the website.
Hello, everyone. This is Charlie. Thank you very much for coming to the webinar. Yes, please. Thank you, Greg. I don't think we're unmuting anyone. Maybe the data originally, the original raw data is from Morningstar, but we do all the calculations ourselves. Okay. Ross has done a very good job here, and I'm trying to explain a few things. Okay, when using the valuation box here, click on the question mark. You will see we explain in detail how each one is calculated. And here I want to emphasize that when you buy a company, you want to know what you are buying. You want to know you are buying the assets or buying the future earnings power. So when you are buying the assets, the book value or net current asset value are important to you. But when you are buying the earnings power, the median PS ratio and Peter Lynch fair value will be very helpful to you. Fisher's value. I'm not sure about Fisher's value. Do you know Philip Fisher? Yeah, I believe that Fisher is different Fisher as you spell here. Yeah, of course, Philip Fisher is of course one of the best investors, and he likes to buy high quality companies with future growth. And I think with that kind of model, that kind of company or Peter Lynch fair value will work pretty well. Yeah, for Greg's question, what's the best valuation method for growth stocks? I would think for growth stocks, the best valuation method is Peter Lynch fair value and median PS value. So basically, it's telling you, according to Peter Lynch, the fair valuation for growth stock is PEG ratio equals 1, and that's how our Peter Lynch fair value was calculated. Yes, Chris, the short interest is from Morningstar, yes. Can we add more valuation models? Yeah, you can always suggest the different valuation models in the contact us button there, link there, and we will always consider.
They want to show how they can scan for them. I forgot to do it on the screener. How they can use them on the screener.
For the
evaluation, like they can find one.
Yeah. You come back. Okay. As I was talking about so when you need to know what you're buying the assets, you're buying the earnings power. Thank you, John. Okay. And as Ross pointed out, whenever you don't know about something, always come to our tutorials. And in this tutorial, we have almost everything we cover, and I always use our search box. Our search box is quite powerful. Here you can search anything like Guru's name and our company name, almost everything here. Okay, if there's no more questions, I will turn this back to Ross. Thank you.
All right, thanks, Charlie. Wanted to introduce you guys, the big guy. Yeah, still here. So, a couple of last things I want to share with you. Then I'll go to the screener, because the cool thing about this valuation models is you can actually use the screener to find stocks that meet those criteria. So instead of having to hammer through 1,000 ticker symbols, you can just scan for them that have a forward rate of return in excess, or scan for them that are trading at a discount of the Peter Lynch value. So I'll show you that in just a second. Really quickly, for any of you guys who are not current members, I can't let you go without plugging the site, right? So just to let you know, premium membership, it's $2.99 a year. It's for the entire year. It's a 7-day free trial. So if you really want to put this thing through the paces, try it out, see if it's worth your money or not, or if it's something you're interested in. Give it a go. It's no questions asked. You can get it. You can cancel your subscription online if you decide you don't want to go through with it. You can call in, no questions asked. You can email, whatever you want to do. 7-day free trial. Also a 30-day money-back guarantee. Full access, whole premium membership with that. It's $2.99 a year. And in addition to the features we're giving you here, I mean, a lot of this stuff is how you can value stocks in your own. We're also going to let you know what the biggest guys in the industry are doing. What is Buffett doing? What is Icon doing? Real-time picks, what they're buying in these hedge funds and mutual funds. In-depth screeners. We've got value strategies that are automated that have been beating the market since 2009 with a nice margin. You can scan for stocks that company insiders and gurus are both buying. We've shown you some of the in-depth valuation models. We've got some monthly newsletters that come out free with this thing, all for $2.99 a year. GuruFocus.com. Just click on free. It's like top right. Hover over sign up or something that's got a 7-day free trial. I encourage you to check it out. If you are a premium member and you are becoming frustrated with the low number of stocks you're finding, we also have global membership that not a lot of people know about. I didn't realize that, so I wanted to be sure you guys were aware of this. We have a lot of subscribers. We're based in Plano, Texas, here in the United States, but we have a lot of subscribers who are overseas, so you can add on other countries to your premium membership for not that much, depending on how much data and how many countries there are, how many exchanges there are. So if you were either a foreign investor looking for data on your home stocks, or if you're just open to international investing, which a lot of people are these days, considering some of the rich valuations of the U.S. market, you can add any of these on. And so the cool thing is they come with a 7-day free trial too. So if you're already a global member, or if you're already a premium member, here's the cool thing. So say your subscription renews in like 6 months, and you want to add Canada, you're not going to get charged $189 today. You're going to get charged whatever it works out to, like $95, the prorated amount till your thing renews. The other thing is you can add and drop regions at any time. So you try out Canada, you say, screw it, I don't like Canadian stocks anymore, I don't want to do it. You can cancel it any time. You can swap it for UK and Ireland. You can do anything you want there. So you're not locked in. There's no contracts. We're not the cable company, right? Really easy just to kind of get in and out of these if you want. So wanted to be sure you were all aware of that, right? Shameless plug. Now you got it. So wanted to be sure you guys are aware of that. So let me show you screeners really quickly and how we can kind of put this to use, because I think it's really cool. Here is the all-in-one screener. And this is one, again, I'm telling you, you can spend hours and think it's really, really cool. Its goal is not to make you 12 stocks you have to buy. It's supposed to give you great ideas that you can find that next great, Panera Bread. Or I just got finished eating some Chipotle. That's a stock I wish I'd owned 10 years ago, right? So here's what you can do. Now I'm going to go ahead and select. Excuse me, hit the wrong thing. I'm going to go ahead and select the USA here as the country I'm scanning for. I'm going to go ahead and exclude over-the-counter stocks. Just, they're a little bit risky. I don't have full data on them. But up here under the valuation ratio tab, you can scan for most of the things that we've looked at tonight. All right. So here's how you're going to do that. Now, notice we're starting with 4,147 stocks in our screener. Okay. You can scan for stocks meeting the valuation criteria we looked at. Okay, so remember the Peter Lynch value? This gives you're looking for price to Peter Lynch value. So if you want to find stocks trading at less than their Peter Lynch value, this is a minimum maximum drop down. So just put the maximum at 1. It's price to Peter Lynch value. Now we're down to 368 stocks. We just cut out 90% of the stocks out there that are not worth our time. Okay? And so we want to throw in some Yakman, right? Forward rate of return. We want a stock that's going to earn us at least, what? I don't know, 14% a year maybe? Let's go bigger. The cool thing is just see how many you got left. Let's go 20% a year. Still got plenty, okay? Let's chop it down further. Let's look at price over the price to sales number. Let's say we want that less than 1, right? We want it trading at a discount of that medium price to sales figure. We'll put that max at 1. Down to 115. We can even use the grand number. I'm afraid it's going to cut it down to nothing, but let's see. Let's max the grand number out at 1. No, still got 45 stocks. Now we can use our discount cash flow model. Okay, and some of you guys were asking, can you use earnings instead of free cash flow? Here it is using earnings. Here it is using free cash flow. So you can choose which one you want to follow there. So let's say it's trading at a discount to that free cash flow figure. Put that max at 1. So now we're instantly down to 13 stocks. You can even go further. Say, you know what? I don't like financials. I don't trust banks. I don't trust. They're tough to value. So we can select all our industries here. And then I'm going to scroll down and deselect financial services. It took out asset management, took out banks, took out S&Ls, brokerages, insurance companies, everything I don't understand. And also wiped out all our records. So let's take one of these off. I think the gray number might be a little bit aggressive. So here we have 16 stocks meeting our criteria. Okay, trading at a discount to the discount cash flow valuation, a discount to Lynch's figure, the price to sales, a forward rate of return at least 20% according to Yachman. These should be good companies. Now we're going to want to dig a little bit further, right? Do a little bit of our own homework, but these are strong companies offering a good, what's the word to say? I don't want to promise anything, but they're offering the most promising returns based on expectations, right? So what do we have? Perialis, I'm familiar with. Apple, I own. Insurance company, Southwest Airlines, great airline. Oracle's another great tech stock and a good deal on. Ebix is actually one Charlie and I are in love with. Bed Bath Beyond's at a discount. Actually, Google made the cut. Surprising. Qualcomm's in there. So, it gives you a great list of stocks. Now, if you're more a growth guy, okay, you think, if you're not really looking for assets and prices, you're like, I want a really strong growth company that meets my expectations. All right, well, maybe you want to come over here and say, I want a small company because I know those are the ones that grow. All right, so I want it smaller than, say, $2 billion, right? I want a small cap stock. Now I'm down to 12, using, well, let's remove this one as well. Let's just focus on the Lynch factor. We want it really cheap. So let's look at like less than 0.5. And here's 28 companies that may be the next great growth stock for us. They're small. They're trading at a great discount to how fast they're growing. Let's make sure they're not ridiculous levels of book value. Let's put this below 4. I guess we can go a little further. We'll kick it down to 3. We've got a nice list to kind of dig into potential growth companies here. Ebix has again made our list for growth and value. Titan Machinery is a company I've traded on. Outerwall is one my brother and I actually have been investigating. Outerwall is a cool company. They own Redbox. They own Coinstar, and they're actually starting, if you've been into Walmart recently, they're starting a new thing where you go in and you put your cell phone or your tablet or whatever on this little box, and the little machine will buy it from you. That's them. So I think Outerwall, if you guys are looking for a stock tip, something to dig into, take a look at Outerwall, OUTR. Really interesting. I'm looking through your questions. Yeah, one-stop shop for screening of financials, exactly. Nay, I don't think they're. No, you can't make live notes on 10Ks like that. We do have Asia, Abdul Salam. Yes, all of Asia. John, can you show us what the site where we can find stuff gurus are buying? Yeah, just put in. I mean, it'll have to do a whole other webinar, but just use the search tab. Look at Buffett, and then boom, profile and performance, current portfolio. It'll show you everything he owns and everything he's buying. Anand, yeah, great question. Is it possible to list an order of difference from discount cash flow? Yeah, absolutely. You can put them. You can order them any way you want. If you do, let's see. If we made that our criteria, you can filter them by. Yeah, I mean it's definitely doable. You just have to click how you want to order them out. There's also custom built screens in here that'll look for those stocks trading at a discount, their discount cash flow, and you can undervalue. Where's undervalue predictable? There it is. So these here to list all the high quality stocks trading at a discount, this discount cash flow valuation figure, and then you can put them in order according to how far below that are. So WRLD trading at 82% discount, DaVita, Newstar, Credit Acceptance, Toronto, etc., etc. So you can order them that way. All right. Well, look, I saw we went about 15 minutes long today, but I wanted to be sure we covered all the information we could. I really appreciate you guys joining us here for another webinar. Once again, if you are not a member, I encourage you to at least do a trial. We're not going to hold your feet to the fire if you decide you don't like it, or it's not for you, or it's something you're not going to get into. Feel free to cancel anytime. Free trial to you guys. Just want you to be able to put it through the paces, give it a shot, and see if it's something that you think can really enhance your investing abilities. And for all you premium guys there, if you're seeing slim pickings in the U.S., definitely check out the global membership. It's got all the same data that we have on U.S. stocks. You can still run the Buffett-Munger screeners. You can still run the forward rate of returns. You can run all the all-in-one screener. You can do everything you can with U.S. stocks. You just check the box to add the other region, and it will show you international opportunities for the same scans you're running. So really, really, really cool. I encourage you guys to check that out. Thanks again. We will send the recording out to all of you who joined us tonight, and we look forward to seeing you on the next webinar. You guys have a great evening.